Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Markets move quicker than ever and are driven by a multiple of factors. Because of this, data is as important as ever in order for investment professionals to uncover alpha, look for investment trends, investor sentiment, and risk signals. Fund flows is a data set that can help investment professionals make intelligent decisions based on facts. Well, today I'm honored to have on an expert on the subject of fund flows and just happens to be a former colleague to provide some great insight into markets. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So I'd like to welcome Cameron Brandt of EPFR on the show. Cam is the Director of Research at EPFR. Cam, thank you so much for coming on the show. I didn't really say much of a bio, so maybe can you start by telling us a bit about yourself that might not be listed in your bio, and then plus about EPFR.
Well, I've been with EPFR, Ryan, now for getting on for 23 years. So I've been with it through several iterations. Many people may not know, but we started as a provider of newsletters covering the new capital markets that broke out in Eastern Europe and Russia when the Iron Curtain fell back in the late 80s, and have been with it as we eventually morphed into what I regard as the preeminent provider of fund flows and allocations data and perspectives on that data. My role has evolved so that I now tend to manage the 30,000-foot view of what's going on, while a number of skilled quantitative colleagues sort of take a closer look at the nuts and bolts.
Mm-hmm. Great, thanks for that. And again, thanks for coming on. So let's start at a higher view, like you said. We just recently received consumer confidence numbers, and consumer confidence rose in November for the first time in 3 months. However, it's not really trickled through to money movement in the market. Still a lot of money remains in U.S. money market funds. Consumer confidence increasing, but what else is going to have to happen in order for that pile of cash that's sitting on the sidelines or money market funds? What will it take to get investors more confident to move that money?
Well, it's not just confidence that, or lack thereof, that's keeping money in U.S. money market funds. And I think you're right to focus on them, because the ones we track have absorbed over $1 trillion year to date, which is, $1 trillion is still real money in this. But a fair chunk of that is money that has finally left the security of the FDIC guarantee in commercial retail banks and come across for the higher returns. The average 7-day yield now in the prime institutional funds we track is up around 5%. So if interest rates stay higher for longer, it may well just stay there.
Mm-hmm.
The confidence question is an interesting one, because we've, especially recently, when the positive GDP numbers and the sinking inflation numbers triggered a rush of cash into U.S. equity funds, also saw at the same time continued redemptions from U.S. consumer goods sector funds, which, there was faith in the broader American story, but not so much faith in what historically has been seen as the key driver of the ever-willing U.S. consumer.
Mm-hmm. Interesting. So, and you brought up a good point there. We talk a lot about confidence, and fund flows are a good way of showing sentiment, right? But it's also yields. We can't really have much of a conversation about markets today without talking about yields, and we're going to get to that shortly. But when you can go on the money market funds, that there's no free lunch in this industry, but get nearly 5%, especially after having decades of below 1%, you know, there's not it's pretty appealing investment.
Yeah, and that it it's hard to really get your mind around quite how repressed yields have been for how long at a critical juncture for what is arguably the largest retiring cohort uh,
Yeah.
in human history. So, um, in some ways, I'm slightly surprised that the switch to money market funds hasn't been more aggressive. It's certainly been very solid, but there's still a lot more money in fairly low yielding certificates of deposit and other sort of savings vehicles of that ilk that
Mhm.
could move across. So whether we want to dive into that or not, but I'm certainly keeping a continued eye on the health of the regional banking sector, how quickly they forget how tense things were back in March. But given that our data is clearly showing money still migrating out of them into money market funds and thereby raising their underlying funding costs, it's my sense that that story may have another leg to run, especially early next year if the interest rates do stay at current levels.
Yeah, and that's a very good point, Cam. And we're still seeing I don't think we've seen the full impact of this 500 basis point worth of rate hikes yet, right? I mean, studies show it takes 18 months for it to fully trickle through to the economy. So there still could be some pain out there.
Right. Plus, in an interesting way, I think they've been more than usually buffered. Again, we keep circling back to money market funds, but before this $1 trillion run up,
Mhm.
we saw $1 trillion run up in the first and second quarters of 2020. And that produced uh, a big pool of money for American consumers to a certain degree to resist the pain of higher interest rates and maintain
Mhm.
consumption levels. And then, employment has remained healthy and wages have gone higher. So, uh, the lag in that those interest rate hikes could be even longer in this cycle. So
Yeah.
we may not really see the impact of them until the middle of next year.
Yeah, and we were such, everyone's kind of freaking out that interest rates are over 5% and yields are around 5%. Now, short-term yields 4.5%, 5%. That's a little
Yeah,
bit unusual. But after, and you mentioned it, after decades of depressed interest rates and yields, now it's kind of like this is people think it's new, but we're normalizing, right? I mean,
right,
this is 10-year yields, 30-year yields should be at 5%, really, right?
right. You know, even at that level, we're not seeing the creative destruction, which is part of a healthy market economy. We should be seeing a lot more businesses that only exist because capital was artificially cheap being washed out. And certainly the sort of sentiment, the broader sentiment surrounding what government should do in the economy has noticeably changed over
Mhm.
the past 3 years. There is much less willingness to let
Yeah.
companies go to the wall, and a much greater sense that the government should basically step in and stop anything that's remotely painful or destructive. So, um, trying to read the tea leaves with the sort of the old lenses, is not quite as efficient as it has been in previous cycles.
Right. Fantastic insight there, Cam. So taking a step back and looking at the macro level, you mentioned GDP. We had just a revised GDP print of over 5% for the third quarter. Inflation continues to soften, and that's provided a boost to equities. Recently, after nearly falling into a correction territory, equities have rebounded here just recently. Has that prompted investors to look at equity funds recently? Have you seen an inflow there? What type of trends are the softening
Yeah,
economy?
the trend is very much that um, investors have accepted the invitation to refocus on U.S. equity funds. To a lesser extent, the U.S. bond funds, they never really left them over the course of this year. Interest, spiked after the initial GDP reading, and while sort of at a higher level than we've seen, has been sort of trending down over the past couple of weeks. There certainly remain some unanswered questions. A lot of that growth is obviously triggered by President Biden's Inflation Reduction Act. That would be a whole podcast in itself. So, is it a sugar rush? Does it reflect some more fundamental improvements? I haven't seen any productivity numbers recently, but certainly the other great U.S. narrative this year has been artificial intelligence and what it will do, in a practical sense to output and productivity. We've certainly been through this before with the .com boom and bust. But certainly the lesson there is that yes, there will be productivity gains. Will they arrive as rapidly as people hope and sometimes pencil in?
Great. We talked about fixed income already in the yield curve. So, and it's hard to talk about markets and not talking about the yield curve. So really until the past 6 months or so, those longer dated yields, they've been slow to react to the Fed's higher for longer rhetoric. And that's resulted in longer term yields staying well below shorter dated yields. While that shorter end of the curve has been very accurate in predicting Fed policy, have U.S. fixed income flows reacted to the steepening of the curve recently, or is there any relationship there between flows and how the curve is reacting?
Yes, that they have. We after most of the interest being focused, or the majority at the short end of the curve, we've definitely seen flows shift towards funds dedicated to longer duration debt. So I definitely a sense that the high tide for the short end may be upon us, and now is the time to sort of try and lock in longer exposure to those higher yields.
Do you think that's what is attracting investors? Is the higher yields? They're finally like, okay, we feel better about these higher yields, let's take advantage of it? Or is it more, okay, maybe there's rough seas ahead still, let's go a little bit more conservative? Or is that a question that again is for another podcast?
No, I'm glad you raised it, because I was just about to. There's nearly always some component of flight to safety in the support of U.S. Issuance, and I don't think this time is any different. The world out there is getting increasingly hostile. It's not clear where relations with China are headed and are going to end. We have two significant conflicts going on at the moment. the Eurozone continues to muddle through, but nobody would call Europe a screaming opportunity. And you know, a fair amount of the emerging markets universe is still, you know, struggling, especially in the EMEA and parts of Latin America. So how you assign a weight to the two, the kind of, as you say, the sort of conservative flight to safety dynamic, and the yield starved baby boomers taking a last rush at you know, getting some decent income flows. You know, that's where the professionals come in, but they're certainly both factors.
You know, you brought up overseas and China. China's kind of the elephant in the room, I think, right now. You know, our relationship with China seems to be crumbling a little bit. Then you have, and I always take the data that we get from China with a grain of salt, but you keep on hearing that their GDP is slowing, and there's bankruptcies happening, especially in real estate with China. What's your thoughts on China moving forward? Is it a space that maybe we need to remain cautious in, or do you take some opportunities here?
It's certainly a space that we need to stay aware of, even when you're very much focused on the US. As you say, China just it's too big to ignore. It
Mhm.
remains too integrated into the way our economy has evolved, certainly over the past 2 decades. The China's troubles should add up to a deflationary impulse, but because trade links are narrowing and tightening, how much of that deflationary impulse will actually sort of come through via cut price Chinese exports as they try and hang in onto market share is very much up for debate. You know, longer term, certainly, um, we're going to get some of our manufacturing base back. You know, when talking about China, I always tell people to start by listening to what the Chinese government is saying. You know, people always sort of tend to look for the double meanings, and that's obviously part of sort of being a good manager. But China is always very direct about its sort of highest level goals,
Mhm.
and that you know, it'll do what it needs to do to get there. So you know, the tightening up of economic information, you know, the squeezing out of foreign companies that can't be milked for more
Mhm.
sort of technological gain, you know, is very real. We're seeing a lot of interest in Mexico at the
Oh,
moment. They seem to be the beneficiary of this sort of reshoring trend.
interesting.
Um, but we still do an enormous amount of trade with China. That cannot stop overnight. There's always the possibility that relations will improve. Certainly, there's a lot for both sides to be gained, presuming
Mhm.
the terms of any new relationship are, um, you know, are beneficial to both sides. And geopolitics, which for a long time was not really much of a part of the discussion, is there, and that's something that I think for investors has been sort of a change that over the past 2 years, all of a sudden, issues that frankly just because of the sheer force of global liquidity really didn't change the equations are starting to once again, and you had referred to sort of the fact that in more normal terms, geopolitical issues and 5% interest rates wouldn't be creating all this head scratching.
Right.
But yeah, there isn't sort of a linear just follow the money and all it'll wash the problems away anymore. So it's a
Mhm.
more complex equation that has to be evaluated, especially by financial professionals.
Yeah, and again, that's probably another topic that we could do for a whole podcast is just
Yes.
China, right? Um, you brought up geopolitics. You've talked about fiscal spending and
Yeah,
policy. So we probably need to talk about what's coming up in 2024, and
yeah.
that's the election. To be honest with you, you know, I don't think it's really been talked a lot about, at least maybe not enough within investment circles. I think there's so much else going on when you're looking at investment markets right now, primarily with the Fed. But do you think more should be made of the election coming up in 2024? Or do you think a lot of times it's just kind of overdone, the impact the election has on markets?
I'm going to give you the classic investment advisor response, which is both. Um, I I do think that we tend to assign perhaps too much weight to a presidential contest.
Mhm.
The powers of the presidency are pretty great in foreign policy and domestic policy. We still have a pretty many would say too great a system of checks and balances, and pretty much presidents these days have 1 year to get a meaningful economic agenda through unless they're throwing a juicy crisis. But given the profiles of the two major candidates, and sort of given the starker issues that are out there and need to be addressed, I think this one could have more of a bearing on the market than recent history has sort of gotten people conditioned to assuming that it will or won't have.
Mhm. Interesting. Speaking of 2024, let's finish up with this question. Get your crystal ball out there, Cam. Looking ahead, what do you believe will be the best or the biggest stories for markets in 2024?
Oh gosh. Well, I think energy will continue to be perhaps one of the biggest ones. There has been much less investment in the naughty fossil fuels, which we still rely on. The U.S. shale patches again taking up some of the slack, but I have to think at some point that's going to come to roost. If some kind of ceasefire occurs in the Ukraine, that is obviously going to make Europe uh, an interesting story. Germany hooks itself back up to regular supplies of cheap Russian energy, then there's going to be sort of a rebound story there. ESG will continue to be a story. It's been sort of a less of sort of a good news story this year. That it's been, people have been looking at it with somewhat more realistic eyes. But that doesn't mean that it isn't here for the
Right.
duration. And I think it will regain. One of the things that I will happen in an election year is that that will be an issue
Mhm.
that occupies a lot. Uh, I, a lot of the issues we're dealing with now, I don't see them just suddenly stopping. So they will carry fairly far, certainly in the first half of last year.
Mhm.
Of next year, what we're dealing with right now, I think will all be, we'll still be dealing with it. We'll still be trying to work out, where this leads.
Yeah. No, that I think you're exactly right. The Fed and everything we have going on with the yield curve, that's not going away
No, so
anytime soon.
until the narrative shifts from uh, higher for long enough, um, I think the core issues that are sort of driving the market narrative now will remain the core issues.
Awesome. Well, thank you so much, Cameron Brandt, for coming on the show. It really was a great conversation. Love having you on. And and just having a
Yeah.
good conversation.
Oh, yeah. A pleasure to re-engage. It's been a
Yes,
while.
exactly. We need to do this more often.
All
Where
right.
can our audience get more information about EPFR?
Well, EPFR has a website with all of the necessary contacts. So just www.epfr.com and go from there.
Perfect.
I'm sure you'd be happy to relay any requests that come directly to you onto us.
Yep.
Thank you.
Fantastic. Awesome. Thank you, Cameron. Again, fantastic conversation. Let's do it again. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you and have a great rest of your week.